Hello there everyone, continuing on today in our series on pre-year-end tax planning in advance of the year-end on the 5th of April. So today it's all about investments, tax-efficient investments. So specifically ISAs and pensions. Now, with an ISA, £20,000 a year, that's the limit. That's how much you can put in to an ISA every year. And it can be stocks and shares ISA, it can be a cash ISA. Now, rates of interest on the cash ISA is pretty nominal. Stocks and shares, you can obviously invest in all sorts of things and hopefully get a much better yield. You could argue, now remember this is not investment advice, but you could argue that right now is a great buying opportunity for stocks and shares with the markets depressed because of the situation that's going on right now. But listen, any time is a good time when there's tax breaks involved, particularly given the fact that no income tax on the yields within the ISA, so any investment returns, whether it be dividends or interest, held within the ISA wrapper, no tax. No tax on the growth, no tax when those assets are sold within the ISA wrapper. So typically, you compare it to assets held outside an ISA wrapper where you would pay capital gains tax at the back end when you sell. With an ISA, no capital gains tax. So you could double your money on Tesla shares, say, within your ISA wrapper, and there'd be no capital gains tax. So, but the limit is you've got 20 grand a year. So you've got to, if you've got a few quid in your bank, looking to invest, get it in the next 4 weeks before the 5th of April 2022 to take advantage of the annual 20,000 limit. So, often we don't think about inheritance tax until it's too late, I would suggest. More and more people falling into the inheritance tax wrapper at the minute, particularly when the baby boomers are sadly passing away, leaving a lot of wealth to the next generation, and the inheritance tax take has never been so great. Now this video is focusing on income tax, but specifically while we're on the topic, inheritance tax can be avoided within an ISA investment if you invest in certain types of shares. Now specifically, those shares that qualify for what we know as business property relief, BPR, and a lot of the AIM companies, so the London's junior market, the AIM stock market, a lot of the companies on there qualify for this inheritance tax break. So in your ISA wrapper, let's say you've got put your 20 grand in, you think, where shall I put it? If you put some in to stocks and shares that are listed on the AIM, but you've got to do your homework because not all of them count. But not only will you save on all these income tax and capital gains tax breaks, but it will also fall out of your estate after just 2 years. Normally with IHT, you've got the whole 7-year clock thing going on. But with a BPR, investing in certain types of shares, it falls out of your estate after just 2 years. So that's just something else to throw into the mix in terms of deciding on which type of investments, stocks and shares to invest in within an ISA wrapper. So, great tax breaks all around, income tax, capital gains tax, and IHT. So, next thing, pensions. Now, I've already done a recent video on this, particularly with regards to getting out of those trigger point marginal gain bands, dropping from 60 to 40 to 20. But anyone can do a pension. It doesn't matter what level, even if you're nowhere near any of those marginal bands, it's going to save you a few quid in income tax. And remember that you cannot, you need to do it before the year end. However, there is this carry forward mechanism that says, look, in terms of how much can you put into a pension, £40,000 a year, 40 grand, quite generous. But if you haven't done your 40 grand quota for the last 3 years, you can actually add that on and do a great big lump sum now. And I've seen that in the past where people have not put into a pension for many years, and in 1 year, quadruple up, put 160 grand into a pension and wipe out whatever tax bill they've got, whether it be in their company or their personal for income tax. This is all about income tax, but the same applies for a company in terms of you've got this carry forward facility that it's not just about the current year's 40 grand. So do consider putting some money into a pension. If you're in that position of having quite a few, having a couple of quid in your back pocket, you might want to do both ISAs and pension. Remember, 20 grand is the max on the ISA, 40 grand on the pension, but in certain circumstances, that 40 grand can be even quadruple, depending on your history. So again, you've got to think about this in the next month before the tax year end. What about putting into someone else's pension or ISA, specifically the kids? Well, you could put £9,000 a year now into a junior ISA for your children. So that'll be a nice little accumulated pot when they get to 18. I mean, that's the kind of the downside as well, is that they do get their hands on it when they're 18. But compare it with just putting it in a bank account for them, which legally would go to their name anyway at 18. They're going to get better investment returns in a junior ISA because, again, like a regular ISA, you can invest in stocks and shares. It doesn't just have to be cash. You can also pay in to a pension for your offspring, for the kids. How much? £2,800 a year is the net amount that you can put in. That's grossed up by the government. I've done separate videos on grossing up, but essentially 3,600 would hit the pension pot. So you put in 2,800. You can do that every year, and of course the investment returns on that would be compounded because it would be there for decades. You start paying into your child's pension, which they can't access till who knows what the threshold would be when they get there, possibly in 60s. At the minute, it's gone from 55 to 57, but it could be 60s. But that's the point. The point is you've got multiple decades, compound growth, and when they get there, crystallizing the benefits, to taking their pension when they're at pensionable age, then that could be a really decent pot. So do consider putting some money away for the kids. So you could do a combination. You could say, okay, yes, it'd be nice for them to have something at 18, particularly with a view to them putting down deposits for houses, that sort of thing, which they want sooner rather than later. And then on the next token saying, well, look, it's never too early to start putting into a pension. So you do a combination. You don't have to max out. You can say, I'll put a few quid into the ISA, all about saving for a house, and then the rest I'll put into their pension to make sure that they're all right when they get to my age. So just a few things to think about there pre-5th of April, tax planning, how do we save, particularly income tax, but other taxes I mentioned here as well, doing it in advance of the 5th of April. So I hope you liked that video. If you haven't yet subscribed, please do so, and I'll see you soon.